Good morning, everyone. Welcome to the room. Hope you all had a great weekend. As you know, trading futures involves risk and is not suitable for all investors. The information in the presentation is for educational purposes only. It's not a trade signal service, not intended to be financial advice. Looks like we're going to open up outside of yesterday's range, so we could have some really good trading opportunities today that I'll try and walk through this morning. Last week was a pretty great week in terms of follow-through, trades moving fairly quickly away from their entries, the market actually making some headway, finishing the week in a different spot that it started, and you can see just by looking at the last 5 or 6 days, we actually had some trending action versus the sideways triangle tightening formation that we'd been in the last handful of weeks. So first thing we'll look for, I've got the previous day's close. Get that up a little higher. So we've got yesterday's close marked, and we're going to open up about 15 points or so higher. So we'll look for the first 5-minute bar to close, and then bracket that first 5-minute bar will either come down and fill the gap, or being that we are down at lows, a gap up is much more sustainable. So I'm okay with gap and go day when we're gapping up down at lows or gapping down at highs. What I don't like to see, or what I'll often see, is when we gap up at highs, like back here, the market fades. So here we've already moved up, the market gaps up, and then that rally isn't sustainable, and then it gets sold. Versus the gap down at highs, a good example back to back, gap down, the market continues in the direction of that gap. Same thing over here. Big gap down, then the market continues. So we will be, looking at that first 5-minute bar. Once we get settled out here, you can see the gap up on the right, on the left rather. I'm all backwards this morning. Got housing market index at the top of the hour, red book, but not the major news coming out today. Tomorrow, housing starts. Thursday, jobless claims and existing home sales. Market breadth, 9 point, I think I saw 5 and 2,000, so pretty strong off the open. I'd look for that to hold. or I would expect it to hold. Doesn't mean it will. So I guess you've got a couple scenarios. You can gap up and immediately start falling off. So a gap and crap. You can gap and go, where you gap up and then continue, or you can kind of gap up and just do nothing, just kind of move sideways. I guess that's what you call the gap and crap. The fade would be the gap up and then immediately fall back down to yesterday's close. So let's see what we got. So we've got a high of 2139.25, so a 2139.50 would be the long break. 2136.75 on the downside. You know, it's possible. So just in talking about different scenarios, you know, the market can start towards the gap, start filling the gap, get halfway, and then reverse. There's you know, there's a lot of different things that can occur on the way to a gap fill or lack thereof. And there's our 36.75. So we'll see if that gives us any follow through, or if we come down and make some sort of rounded bottom or V reversal, or you know, come halfway down, put a hammer in. But the nice thing is, on these bigger days that we gap like this, there's typically a little bit more activity that you'll see. You know, the last handful of Tuesdays we've had inside days, and those have been somewhat lackluster. There's not many setups. There's not much follow through. The setups that you do have are fairly dangerous and choppy. So with just letting the market kind of being a little bit more active when the market opens up outside the previous day's range, just that in and of itself is a good way to kind of single out better days to trade than others. So we'll see if this turns into anything. The low break of the first 5-minute bar, and you know, by bracketing, it's going to break one way or another. If it doesn't break within the second bar, like let's say the first 5-minute bar closed and then we just stayed inside bar following that, then I'll just scratch the first 5-minute trade. At the same token, if we are within the previous day's range, I'll usually skip it and those are pretty much the two main things that I look at. You know, some days you get really nice bar after bar after bar with no break of the previous candle's high. In this case, because it broke to the downside. You know, there's other days where you might go a couple of points and then the market turns around, or you go a couple of bars in one direction and then you get a reversal. But at least it's a way to kind of jump on the train in the morning. If there's going to be a really strong trend, you don't always get a halfway back later in the morning. And so that's a good way to kind of attack the markets right off the open. You can see yesterday we did open up within the previous day's range. It did end up working out for a couple of points, but that's just kind of my way to be a little bit selective in terms of not getting chopped up. Because if you open up in the previous day's range, you could start right away with being in the inside day. So we broke below the low yesterday, strong move down, couple points, next candle, and then we broke that on the third candle. Last week, gap down, gap and go, broke down below the first 5-minute candle, down, 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 started to round out, broke the previous candle's high, and that's what gets you out of the trade. So last week was a pretty good week for 5 minutes. Again, opened up inside on Wednesday, and so the move was not as strong. And I think Tuesday was pretty good. Yeah, opened up and then down, 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 down. A couple of inside bars. I don't bother trailing my stop above those. I just leave it at the breakdown bar. Broke down again, down, 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 hammer, and then broke above the hammer's high, and that's what got out of the trade. So once this bar closes, just going to leave things alone for now. So I got my stop at -6. If this candle can break the low, or if we do get a double bottom, I will, that's one, a double bottom or a double top, you could consider it an inside bar, but at the same time, I see that as, so you could say, well, you know, I'm just going to leave my stop alone. But when we do get the double bottoms, I will bring my stop down, just because a double bottom reversal pattern can be fairly strong. So if we can either close this 5-minute bar still being in the trade, or whether we break down below this previous candle or not, because the two lows line up, I'll move my stop down. We got a couple opposing 15 minutes that are holding here. A 37.25 short. I don't like to get too aggressive within the first 15 minutes. And then we're currently sitting at a 21.36 long. So we'll either come up, hold the 37.25 and sell off, move lower, or this long will hold and we'll come up and break the 21.37.94, and then we can start taking long setups after that. If that's the case, if the short holds, then our short here will hold and we're already in the trade. So we'll wait and see for now. Ticks have come down. Seen some 300s. The breadth is down to just about 5 to 1. Advanced decline line still at 2,000, so we could get a rounded out open where we kind of get a little bit of selling. Sometimes that's profit taking for those who had overnight positions, or in the pre-market. Profit taking lets the market come lower, and then it continues, and then reverses, and then the trend, the gap direction continues. But you never want to count out what you're thinking might happen. For example, sometimes you've probably been in a trade, and if you're using a 6-tick stop, the trade comes 5 ticks against you, and then it reverses and ends up being a big winner. Well, if you just feel or let your emotions or let your bias take place while you're taking some heat on a trade, and you say, it's starting to come down, it's close to my stop, or it came down 1 tick away from my stop, I'm going to get out, then you're not allowing your stop to fully do its job. So there were times where I would literally sit on my hands and let the market either come to my stop at -6 or go to a target of 3 times my stop, so 18 ticks on the ES. And then I started adding a trail stop within that, and that helped to alleviate some of the loss, or lock in some profits on the way up. So now, since we've got this double bottom, I'm going to take my stop down to a 37, which happens to be a tick off our entry. I wouldn't always move my stop. If this was just an inside bar, any old inside bar, I'd leave my stop alone. But because it's a double bottom, meaning the low is at 35s and the previous bar low is at 35s, that can sometimes be a strong sign of a reversal. And even though it's just, it's a 5-minute chart, and it's not necessarily a touch of a low, a rally, and then second touch of a low, visually, it is, if we went to a 1-minute chart, you kind of see we touched, we bounced, and we touched a second time. So on a real small time frame, you can see it. Over here in the 512, you can see it, where we've double bottomed. Pretty small, but I figure I don't want to, those don't happen that often, and when they do, maybe 50-50, they end up reversing. So that's how I play the double bottom scenario. The likelihood of the market breaking this third candle high, stopping us out, and then turning around and rolling over, I just haven't found that to be as likely as breaking the third candle high and then changing the direction of a trend, especially with the gap up and seeing that the market breadth, it's still strong even though we were at 9 to 1 at the open, but more importantly, the advanced decline line is still pretty strong. So I'm going to leave it at 37s for the time being, which, hey, I mean, that's basically, I would consider that scratch break even on the trade. So our risk has been diminished pretty quickly right off, within the first 10 minutes of getting into the trade. We've been able to reduce our risk, not just because of some arbitrary trail stop that you're putting on. It's based on the market activity. So not only is that line up better with what the market's actually doing, but it kind of, from a mental aspect, you don't feel like you're just setting these arbitrary trail stops or ranges. Maybe you're using a advanced true range or something that's looking at the average range of the day, but just by using the price and candlesticks the highs and lows. You know, simple works. That's all I'll say about that. So now that we've broken down below the previous candle once again, as soon as this bar closes, can move our stop down to a 36.50, which is just the high of this candle. Unless in the next 30 seconds we come up and make a new high or break the previous candle, that would be where I'd take my stop to next. So it didn't come up all the way to a full 50% retracement, but little one is held. So now the next candle is starting to form. Stop goes to a 21.36.50, which is just one tick above the high. So now break even is locked in. You can see so far ticks nice and clean. You know, a nice string of red bars, some green bars, another leg lower. So looking like a pretty good day, and you know, just the fact that we're outside of the previous day's range. I mean, that says so much. And when I first began my trading journey years and years ago and got mixed up with a bunch of Chicago traders who'd been doing it for years and years, since the 80s, since, you know, computerized trading first came about, you know, they could not stress enough that simple works. If you want to do this for the long haul, simple is very important. So if you're not a fan of the 5-minute, or if you don't get in right off the open, once the first 15 minutes kind of settle out, you can start looking at the 512 tick chart to jump in. So then once this candle closes, then I'll take my stop and put it above this candle's high, and just keep doing that until we break a previous candle's high. You'll notice the highs on the way down here, we've just kept going down, down, down without breaking. Came down to the 0 line. Breadth down to 3.5 to 1. The advanced decline line still 1700. I've got the previous swing highs marked, 43, and then a swing low at 775. It's also important to remember that trading, it's not about being right or wrong. It's about trading the same way, having the same approach, that you can come in to the markets, be looking for a set criteria, and then trade based off of what you're seeing. I think that's why, at least for me, sometimes it can be a little challenging to do some of these live trading sessions, just because you have a thought in your head that is more of a biased thought. Oh, I think the market will do this, or I think the market should do this, and then something else happens a couple minutes later, and then your bias changes. Therefore, how you might react changes. And I think that's hard sometimes for people to grasp, to say, well, we were just looking at the market in one way, and now you're changing your mind and acting in a different way. So it's important to act the same way each and every time, and just kind of make a note of those thoughts that come into your head. And when you're having to verbalize things, sometimes those thoughts that you might just acknowledge and set aside end up becoming verbalized. So this next candle has closed, started forming the new candle. The high of the previous candle is a 21.35.25. So I'm going to set my stop one tick above that. So a 36.75 entry. Our stop is currently 35.50. And then once this next candle closes, if it closes below the previous candle's high, we know, so it's already started, the lows are lining up. So if it had just, we have a couple candles in here that are inside bars, I'm going to leave my stop alone. But in this case, we have a potential here for the market to reverse. So once this guy closes, I'll keep moving it down. At some point it's going to break, but in the meantime we just keep trailing on the way down. So 33.25, that was our break of this little previous bar. If you don't want to tighten your stop that tight and essentially get kicked out here, you can leave your stop up at the big body down bar, 35.50s. Like I was saying, when we get two candles that line up with the same bottom, could be a reversal. Or you can take one off and then trail the second if you've got multiple contracts. I didn't get my stop moved down in time, but doesn't mean I shouldn't necessarily close one off since it did break by a tick. Could be some sort of bear flag, or we've moved down, move sideways, consolidate a little bit, and then get another leg lower. So if you're trading, I guess there's two ways to go about it, and three options. Stop above the 21.33.25, get you taken out because we broke by one tick because the lows lined up. Keeping your stop conservative at a 35.50, letting the market continue on, or a combination of both, taking half off at a little tighter stop, leaving half at a little bit looser stop. And you can swing trade it just like I would a daily chart. Let the market come back up, roll over, move down again, and then move your stop down to the next swing high and continue doing that all the way down. But even if you're just doing one contract or all in, all out, 4 points isn't that bad for an opening trade. the next 50% retracement trades, holds inside the big body candle down, but starting to drift up just a little bit. We'll see if this 2134 can take us down to a 2130. Sometimes I get the question, if you're in a setup in one direction, in this case to the downside, off the open, and we get another short setup, can I add to a position and I would look at it in the way of open risk on the table. If you had another setup occur and you still had your initial stop that was a full stop open, so if your stop was still at -6, then by adding to the position, now you're adding to your full risk. If you've got your stop moved down, then putting on, or you've locked in some profit, then putting on or adding to the position maybe with a half size of the amount that a normal position would end up adding to a winning trade, and I'd be okay with that. But it's just, you don't want to be adding positions, just like when I'm looking at swing trading. If I were to put on 5 new positions in the same day, now I've got 5 fully open risk positions, meaning my stop is at the full amount all at once. Whereas if I put on 2 on Monday, and then the following week or later in the week I get 2 more entered in, and those original 2 have already moved in my favor and I've started trailing my stop, now my risk, my total risk on the table has shrunk. Or if you're in a profitable, if you got a couple open positions that are in profit, then it helps, you're adding to either that position or putting on a new position, and your total risk is shrunk quite a bit, diminished. So always looking at the total risk on the table. Yeah, Christopher. I mean, if I know guys who just take one setup or look for one setup every single day. Sometimes they don't even end up taking a trade because their one setup didn't occur. So, yeah, the question of being profitable is just a matter of being consistent with your trade management. You might take 4 points one day and then go 2 days without a trade setup because you've opened up inside the previous day's range and that negated an entry. And then the next day you might have another 2 points. So consistency has always been what I've strived for, and then profitability as a result of that. I think the biggest, being profitable in the short term, while that's important, it's important also to keep an eye on the bigger picture and look at, okay, well, if I can take 500 a week from the market or 1,000 a week from the market or such and such per month, pulling that out of your day trading account and moving that money into longer term investments that can then pay you back in the sense that you've got 100,000 workers in the form of dollars out there paying you a monthly dividend, or you've got money in real estate, or you've got money in these assets that is paying you back while you are not having to work. So, if you think towards retirement and what does retirement mean, or what does wealth mean, it's the ability to generate cash flow without having to work. So if you've got $500,000 in the bank and it's returning 10% a year, then it's returning $50,000 per year. And if your expenses are less than that, then you are sort of infinitely wealthy in the ability to pay your expenses, retain your principal, and live on and let that principal be inherited by the children or gifted to organizations and things like that. So yeah, absolutely. It's just important to keep in mind the bigger picture. So you'll see we've got that little double bottom. We had a little bit of a bounce, a couple of inside bars. So if you've got multiple contracts, you can take half off or take one off at the more aggressive trail stop. Leave your conservative stop above that breakdown candle. Let the market kind of digest, move sideways. If you miss the entry, you can always get in later in the morning at a 50% retracement and ride it down. And the same thing goes the trail stop method for the 50% retracement. For those that are new to this style of trading, I will start with a -6 stop. I will then wait for the market to break the previous swing low, that anchor point, and then when we do, start trailing my stop down, and then I'll take half off at the target and then trail that second half above each candle's high in shorts and below each candle's low in longs. But you got to wait for that swing low to break, because otherwise you get these scenarios where you're chopping around, or you haven't gotten away from the entry too far yet, and then if you're going to start trailing right from the initial entry, then you get chopped up in the first 5 minutes for basically scratch or a point on the trade, and you miss out on all this profit potential. So you just got to ask yourself, what's the bigger goal? A lot of people turn to trading because they want to quit their job and sit on the beach and click their mouse for an hour a day and make $1 million, and it just, it doesn't work that way. There's so much screen time and time spent in front of the screen, in front of the charts, developing the confidence and conviction in your method takes, you know, years for your brain and your body to just be comfortable. You know, you see the setups every day. Some work, some don't, but developing that belief in your system that typically comes, at least for me, it comes from seeing the actual numbers, because I can find setups all day long and see, you know, entry to target, see these setups work like crazy, but for the brain to really be comfortable and not hesitate on that entry, I find that, you know, looking at the numbers, the statistics and things like that can really be helpful. So now that we've broken down the second half of your position, or whatever you have left, whether it's one contract all in, all out, stop can be placed above the high of this breakdown candle at 33s. So 21.3675s was the entry. Stop is now at 21.33s. Just like good investing is boring, good trading is boring. Yeah, that's right, Chris. So there's, you know, a bunch of different ways you can get to a profitable expectancy or R multiple, and you can just Google expectancy or R multiple over to the blog and see some webinars and videos on that, especially in the members area. There's some specific R multiple and expectancy webinars, but you know, if you can target 3-to-1 reward to risk, typically when you average out with, you know, sometimes you'll start moving your stop up and you'll get taken out for a smaller loss than a full stop. Rarely do I get a full stop. At least the number of trades that are full stops are pretty small. And then a little bit larger number are trades that are small losers, as well as small winners. And then maybe a quarter of the trades are bigger winners. A quarter or a third are the larger winners. But if you can be, you know, around 60% win percentage, then with a 2.5 to 1 reward to risk ratio, then that gives you enough wiggle room to account for commissions, to have maybe a little bit of slippage here and there, and to actually be sustainable in the long run. There's times where you might have a week where you have 80% win rate, or there's times where you might have a 30% win rate. But by the average size of the winning trade and losing trade fluctuating as well, you could have a 30% win rate, but have a week with a couple giant winners, and you end up net profitable higher profit than a week with 80% win rate, and of the 80% winners, they were just small winners. So, but realistically, 80 to 90% win rate is not necessarily something that I've seen on a long-term consistent basis. There's weeks where I've had 80% winners and just a couple of small losers even, and it's almost like every trade that week was a winner, but that's not very common. There's other weeks where I've just had 3 or 4 trades, and only 1 or 2 of them was a big runner, and the other trades were nothing to write home about. And so you're still profitable, but the percentages are flip-flopped. So this is a good example of an inside bar, not a double bottom, just an inside bar. So leaving the stop alone. Sometimes these trades can last all morning, and that's okay. It's not about the frequency, the number of trades. It's about maximizing the profit per trade. Could have drawn that up a little sooner. Yeah, Christopher, I always start with a 6-tick stop. There's a few cases where I'll tighten it if there's a swing high or swing low right near it. But, or you could say, you know, if you're entering at a 50% retracement, you could leave your stop, round out the 61.8 and add a tick. And if it's within 6 ticks, maybe it's 5 ticks. But I'll never go more than 6 ticks on the ES. 5 or less. I'm sorry, 6 or less. there's our break. Ending our short for the morning at 33. So 36.25 is down to 33 with one exit at 33.25s and then the second at 33. So now as we go into the morning, we will look for, we'll see what happens at the full 50% retracement. I'm not going to take this one blind limit because we could reverse here, consider this a half gap fill, and the market could take off. But I will watch the 2134 level, see if we get some sort of double top or signal a break of a swing low. Current low tick is 21, and that is currently the low of the day. So that could end up being the low of the day because they line up. If they didn't line up, if we had a low tick and then we had a lower price, we would typically continue to make new lows. Breath has come down a ton though, from 9.5 to 1 at the open all the way down to 2.5. The advanced decline line still pretty strong though, up around 1500, meaning on net 1500 stocks are moving up versus down in the New York Stock Exchange. Some traders like to combine the breakout method and the fib retracement method, seeing as mostly at bigger levels. So if you've got a big 50% retracement drawn up, as we do here, you can look to the 5-minute chart for a high to low bar break to place your entry versus just placing a blind limit order at a larger 50 where your 6-tick stop might be outside or inside rather of the 61.8 or right on the edge. So that's one option. Or you can wait for the market to kind of move up in a little bit of a series, forming a high and low, some swing highs and swing lows that you can use as anchor points. And then once they break down, in this case break below the swing low, then you can enter on the first 512 setup after the larger halfway back setup. So as we start to slow down this morning, you can notice that we're right in between the 250s, and we could stay there for a little while. But I would look for a move off of 21.31.25s or a breakdown from 21.34s. And if we get that, then we should have a little swing high or swing low break that we can then enter off of a 512 tick chart. So not a bad little morning. Sometimes getting a trade right off the open keeps you in for a good 30 minutes or an hour, and it makes things pretty quiet and easy to trade. So far that 721 is still a low tick at 721. We have a low tick at the same time that lines up with the same price. Advanced decline line looking decent. Breadth has come down quite a bit more, but if we look at the daily chart, you can see we're still within the range of the high and low from the major swing high and swing low, most recent anyways. So tomorrow, same thing, looking for us to break out from the previous day's range, which would give us another good day to be trading actively versus sitting around in a choppy day that's an inside day. So as we approach this 21.34, I'd be looking for that to touch and either get a breakdown, in which case you can take a short on the 512, or a failure of the 61.8, and then you can wait for the market to come halfway back long and look for a setup off there. So if you have more questions, as always, my inbox is open, tim@emoneymind.com, and we will talk to you next week. Thanks, everyone.